Hey, welcome. This is a tax presentation brought to you by the Coldwell Banker Wealth Builder Program. Today we're doing this on HR1. We're calling it HR1 specifically so that we can take all of the uh, political and other persuasions off the table, any of those connotations. HR1 is technically the tax act that was passed last year. You probably all know it by its more media friendly, the One Big Beautiful Bill. What we did is we have a lot of advanced planning specialists that are available to us. We asked them to review the One Big Beautiful Bill, take a look at it and see how does this benefit not only self-employed individuals, but from you as realtors as far as the real estate business is concerned. For those of you who don't know, you can shoot that QR code on the screen. It's going to open up my calendar. Happy to have a conversation with you, go over, what's important to you, what you're looking to do, any questions that you might have. For those of you who don't know me, my name is Tom Alessi. I am the local professional for the Coldwell Banker Wealth Builder program in the Metro Boston area. Our job is to make sure that your financial security is set. With that in mind, what I want to talk to you about today is taxes, and specifically the benefit of this one big beautiful bill and what it means for all of us as self-employed individuals, but more importantly, some of the relative aspects that can possibly help you in your real estate business. There's a lot of disclosures on the screen. I am not going to read them to you. Just know what it says on the screen is that I am not an accountant and I don't play one here on Zoom TV. If you ever have concerns or questions or need help from a tax perspective, we highly recommend that you seek out the help of a tax professional. All right, let's get right into this. This may be the biggest thing and the best part of this whole act is the fact that bonus depreciation is back. Bonus depreciation is back to 100%. For those of you who know, back in the tax law change, it was about 2017 or so, used to be 100%, and then they started making changes where it started to slowly shrink. Whereas going into last year, into 2025, that number was down to 40%. It's back up. It is now at 100%. So anyone who is a business owner who is making investments into the business, i.e., buying commercial property, buying commercial vehicles, buying power tool equipment, that can now all be written off in the single year at the full 100% of the cost of that item. As far as your business is concerned, one of the factors here is before it used to be if I had someone who was buying a commercial property, an investment property, they amortize and they still do out over time, right? You got the schedule that's like 27 and a half or 39 years that you can amortize the depreciation on that. But the improvements, the HVAC, the electrical, that type of thing could be broken out and be done in a shorter time frame, 5, 7, 15 years in terms of the amortization on that. Well, now with a bonus depreciation being scrolled back and being now 100%, they have now made the rule that it can be taken all in the same year. So from a practical standpoint, if we look at somebody who's interested in buying, let's call it a $600,000 investment property, and they might be able to do improvements on that to upgrade it to, and that could cost what, 125,000? Well, now they can take that full 100 or 125,000 right off in this year, which means if there were questions, well, I'm not sure that property is going to work or it's not going to work. Now that property may definitely be, oh wait, this now could become profitable by taking those discount, by taking the depreciation, by being able to write all of that off in the single year. So a big benefit for all of us. The number one way that the self-employed, all of us take advantage of this or that we can is through the ability to write off a vehicle for business purposes. In this case, it's Section 179. It's always been affectionately referred to as the Hummer rule because there's two caveats to it in order to be able to write the vehicle off. The first one is you have to use it more than 50% of the time for business. That's the saying that works for all of us. But the other is it has to weigh more than 6,000 pounds, i.e., the Hummer rule. Well, it doesn't matter what automaker that you choose, which automaker you prefer to drive. I'm going to tell you, they all have a vehicle that fits this criteria. Whether we're talking the Yukon Denali or the Jeep Grand Wagoneer or the Tesla X, they all have a vehicle that weighs more than 6,000 pounds. Just whether or not you want to do it. But here's the thing. The way this used to work with it ratcheting down was the code 179 says there's a certain amount that you can write off in the year. This year, that's like 30,000. But with bonus depreciation, last year you really, until they passed the law, couldn't change that. That was pretty much the number you were going to write off. Now it says you can take up to 100% of the cost of the vehicle. So to put it in simpler terms, if you were going to buy this car and it was going to be $100,000, and let's just say for my purposes, I use it 75% of the time for business, that's saying I could write off $75,000 on the cost of that vehicle. With Section 179, if I only made 60,000 in the year, that's the maximum that I could write off. So the 100,000 vehicle, if I only made 60, the max I could write off was 60. But with bonus depreciation, I can actually write off up to the 75,000 or take a $15,000 loss. And I can apply the loss not only to this year, I could push it into next year. So not only did I buy the vehicle, I wrote the whole, all that I made off, and I pushed the overage, the difference, out into next year. Now, you want to tell the IRS that you use that car 100% of the time for business, that's up to you. I'm just going to tell you that might raise a little red flag with the IRS. So be careful when you do it. Just make sure you're following the rules and going through everything. The last piece on 179, this does not have to be a new car. It just has to be new to you. You can buy a used vehicle and do the same thing, just depending on what you took it for. All right, shake up. This is the SALT deductions. This is state and local taxes. State and local taxes, we're able to deduct them as the self-employed individual. We can write off up to, last year was up to 10,000 of state and local taxes as a deduction. For 2026, that number has been increased to $40,000. It's gone up dramatically, and it's going to increase 1% every year until 2030. So if you were paying more than 10,000 in state and local taxes, which a lot of us tend to do, that means we can write off more this year. And going towards those that you are dealing with, your investors, let's face it, if they've been writing off that tax and they're looking at purchasing another property, now they can write off up more, which may free up a little bit extra capital to say, wait, I can write this off now and I can get a little bit more. I can free up some additional monies to make this deal happen. So a big benefit, again, 40,000 is now the cap for this year for state and local taxes, and will stay that way until 2030. Retirement plans. So just know you can contribute more in 2026 than you could in 2025. That's a good thing. If you're doing a SEP IRA, that's a simplified employee pension. That's what it stands for, SEP IRA. The number to use is your net Schedule C. Whatever your Schedule C says, understand you can contribute 25% of whatever that number is. On a solo K, that number is based on how old you are. If we're dealing with somebody who's under 50 years old, and let's just say your net number was 100,000. In a SEP, you could put away $25,000. In a solo K for 2026, you could do 24,500. So you can see that that break-even point is roughly right on $100,000, depending on which way I want to go. I will tell you the difference with a solo K is not only can you make pre-tax contributions, but you can make after-tax Roth contributions, and you can take a loan from the balance. Both of those, the loan and the Roth, are not available in a SEP IRA. The wonderful thing about all of this is you can do this through Coldwell Banker, through the Wealth Builder program, direct from your commission checks. That's a home run to be, whether you decide to go SEP, whether you decide to go solo K, whatever you're doing right now, just think about being saying, I don't have to think about this. I can just elect an amount, 5, 10, 15, 20%, and it's going to go right into my retirement account. I don't have to think about making a contribution. One last piece on this. If you are making more than, say, 250, 300,000, we should have a conversation about looking at doing a defined benefit plan for you. The defined benefit plan will allow you to put 2.5 times more into a retirement plan than the limits that are on the SEP and the solo K. So one last piece with this is just realize we're talking about tax deductions, bringing your taxes down. That's the whole point of this presentation. The one thing with that, though, is if I'm lowering my taxable base, am I taking away from my future source of guaranteed income, Social Security? With a SEP or solo K contribution, I am lowering my taxable base. I am still paying FICA, which means I'm lowering my taxable base, but still getting that benefit, that future guaranteed source of income, Social Security, later on. It's a win-win in that situation. So again, just to be wary of what you're trying to do and how you're trying to make it happen, and we can answer those questions. Set up a time to sit down with me. A health savings account. So if you're paying for your own health insurance, more than likely whatever insurance carrier you're using has the same or very similar plan, but with a little higher deductible possibly, or even the same deductible, but with a health savings account attached to it, otherwise known as an HSA. HSA is truly the only free tax-free bucket that's out there. Everything else has a tax bite to it. If you put the money into an HSA, it goes in pre-tax. It grows tax deferred, and then when taken out for medical reasons, it is tax free. And it is not a use it or lose it. You can let this grow. So much so that once you have the deductible covered, and let's say you've got a $4,000 deductible, I got $4,000. Any amount that goes over into the account, over the $4,000 deductible, I can invest it. And I can let it sit there and grow. And it's a conversation I have with my wife every year because she says I've got copays or deductibles or this thing or that thing. And I'm like, no, we're paying that out of pocket. This just sits there because later when we retire, when we get old, we're going to have, prescription drugs and Medicare premiums and all of these things that we got to deal with. And now we have a tax-free bucket to take care of that. So again, if you're paying for your own health insurance, I would explore with your carrier to see, do they have an HSA available for you, and take advantage of this because it is truly the only win-win-win from a tax perspective where you never get taxed on this money. Now we come to the doom and gloom portion of this presentation, unfortunately, but the Center for Medicare Studies at the end of last year said that right now the 7 out of 10 people over the age of 65 need some sort of assisted or extended health care. That's 70% of the population. And 2026 is a banner year when we're talking about the baby boom generation because the front line of the baby boom becomes 80 this year. That's right when long-term care, the average age that somebody turns on or needs long-term care is like 79, 80 years old. That's when they start needing it. And that's where the baby boom generation is. This is a silver tsunami that's running into Medicare, and it is only going to get worse and cause more problems. One of the ways to resolve this or think about it from a long-term planning perspective is to have insurance to back that up. That's long-term care insurance. One of the nice things is that the long-term care insurance premiums are tax deductible. The government did this because they realized that silver tsunami is coming. The problem is for the W-2 population, in order to get that tax deduction, they have to itemize their return. 98 something percent of the W-2 population does not itemize their returns. The standard deduction is better. For us, as business owners, it's actually an above the line deduction. And you can see the numbers behind me. It just gives you what that is, depending on your age, how much of that premium can be written off, and then you can write that off. And that's the thing. So if you're between 50 and 60, you can see that number, it's $1,860. Whatever the premium is costing, the $1,860 is an above the line deduction for business owners. That not only includes you, it also includes your spouse. So just know that this is another way, another deduction when we're talking about planning, taking care into the future about ways to handle and help yourself. Last one, this is QBI. That's qualified business income. Qualified business income was going to expire last year. Qualified business income is a 20% deduction based on, your earnings and where you fit in it, and all of us as self-employed individuals fit into the criteria to qualify for QBI. It was going to expire. They now, with the one big beautiful bill, have taken that and made it permanent. So now it's a permanent part of the law as far as the taxes are concerned, which is a great thing. And more than likely, if you're using somebody to file your taxes, an accountant, a CPA, they're already taking care of this for you. This is just more for somebody who might be doing their own taxes to be aware of it and to be know that this is available, that you can write off of the first 20% of income with this deduction. This is again a powerful tool that fits for everybody that can take advantage of it. There are some phases, phase outs that come in, but that's at a much higher level in terms of when you can get in and how much you have to earn to get out, that type of thing. But just know it is available and now permanent for everybody. That's everything that I had for you on what was the one big beautiful bill, right? So, as far as my services are concerned, I am available to you. This is part of Coldwell Banker's wealth building program. This is made available to you. There's no cost for this. Set up a time, shoot the QR code that's behind me. Just, pause the recording, take out your phone, shoot that. It's going to open up my calendar, set up a time. I'm happy to go over with you whether we're talking about, hey, I want to start planning for retirement. I'm talking about that long-term care thing. Look at some other tax things that you're doing. Anything that we can do to support you, support your business is what we're trying to do. Our goal, our job is to make sure your financial security is set. With that in mind, let's set up a time, let's get together, shoot that QR code, and let's figure out what is best for you. Thanks, and look forward to the next time I get to present some more information for you.